Welcome to this Business Tax Roundup for this month. My name is Dean Wootton. Initially, we're going to look at an employed or self-employed case, and it concerned Gareth Phillips. Now, C&G is a broker, and they developed a medical malpractice product with an unrelated company. And they engaged Gareth Phillips, who had both experience and the contacts they needed. Now, Gareth Phillips was pretty much left up to his own devices, and he negotiated with Newline, a potential underwriter to the insurance product. And he put in the contract a key man clause whereby the contract with C&G would be terminated should Gareth Phillips ever leave C&G. But there was no business actually written under this contract, so it didn't actually come to anything. Now, Gareth Phillips also negotiated with another insurer, AM Trust, and this did generate commissions in 2012 for C&G. But that contract was terminated in 2013, and shortly after, C&G and Gareth Phillips parted company. It didn't seem to work for them. Now, there was a draft contract for services and an employment contract for Gareth Phillips, but it was left unsigned. Now, after leaving, he wrote to HMRC and he says, "I'm having difficulty obtaining my P60 from C&G." And you can just see where this is heading. So all the money he's had, he's saying, well, that's surely his employed income. Now, C&G stated that Mr. Phillips had never been employed by them, and therefore he's not going to get a P60. HMRC were of the opinion that he was self-employed. He was paid on a tiered commission basis, no salary entitlement at all. Now, this case went to the employment tribunal because it appears that he was after employment rights. So he was claiming unfair dismissal, breach of contract, holiday pay, unlawful deductions, etc. But the employment tribunal found him neither to be an employee nor a worker of C&G. So the employment tribunal found that he wasn't employed. But does that make him self-employed for tax purposes? Yeah, they're not the same rules. So it's the first tier tribunal for tax purposes. Now, evidence was lacking. There was no sight of the rules stating that he must be employed. There's no evidence that key man clauses applied. They were unsigned and no business. Because that key man clause did say if you cease to be employed, but it was never actually signed. And there was no evidence as to the terms of C&G's PII coverage, professional indemnity insurance coverage. So there wasn't a lot going for Gareth Phillips' employment situation. Now, the tribunal found more going towards self-employment. They found that he set his own working hours, arranged his own appointments, pretty much left up his own devices. There was very little reporting back, and when he did report, it was pretty much ad hoc. He negotiated the terms of the binders with the insurers himself. He was remunerated on a commission basis, no regular pay or any pay slips. And if there was any intellectual property rights going around, he retained them. So Gareth Phillips was held to be self-employed. So unfortunately for him, he wasn't employed from an employment law perspective and also from a tax perspective. He was self-employed. Let's look at a high-profile case. I'm sure we've all read about this, and this is the Gary Lineker case. It's actually Gary Lineker and Danielle Bucks. And now this is Danielle's, Gary Lineker's former wife, and they formed the Gary Lineker Media, and it was a partnership. And through that partnership, Gary Lineker provided presenting services to the BBC and BT Sport. Now, HMRC, in my opinion, quite rightly, believe those arrangements fell within the intermediaries legislation, and they were seeking to collect around £5 million. Now, it's not going to be as bad as that, £5 million, because obviously they've paid a lot of self-employed tax, but it grabs quite a headline. Gary Lineker, £5 million. Now, this case isn't about yet whether he is caught or not caught. This case so far is about him wanting to hear the quantum and liability at one hearing, so all at the same time. And that's what this particular point was on. And it was decided that the tribunal will determine quantum and liability at the same hearing. So we've got this one to look forward to. We don't know the exact facts, but I'm thinking he's on pretty shaky ground. But who knows how this case will be. But when you have these long-term contracts, with the BBC and similar, then quite a few of the recent cases have been going in HMRC's favour. Now, maybe Gary Lineker's got little bits and pieces in his contract which gets around that, but we'll see that as it comes out. But from our client perspective, we should be very wary of clients with long-term contracts. Thankfully, well, not thankfully, because it's probably a bit of a pain, but since April of this year, the IR35 decision has been taken away from us, and the end client is making the IR35 decision for our clients. But there is a small end client exemption, so we still will be responsible for commenting or determining whether our clients are caught by IR35. And the ones that we should be wary of are those long-term contracts with one provider. Right, so interesting case regarding compensation for lost profits. Now, this was a company called Charlton Chauffeur Driver Limited, and they provided international ground transportation services. They ceased trading towards the end of December 15. Now, unfortunately, the company's bookkeeper had been embezzling money between 2004 and 2012, and it was quite a substantial sum. Now, they were sentenced to prison for 4.5 years, and the Accounts and Corporation Tax returns showed the embezzled funds as deductible business expenditure. Now, legal action was taken against both the negligent consultant, accountant and auditor, and the company received compensation out of court settlement of £566,000, and they treated this as a capital receipt. HMRC argued that it was a trading receipt. Now, in the first tier, the settlement was a decision commercially taken as being the best way to achieve optimal recovery of the losses that the company incurred. It was compensation for loss of profit, not loss of cash. The embezzled funds had never been taxed, but they had been deducted as a corporation tax deduction. Therefore, it was only fair that the compensation was brought in as a trading receipt, and that seems to make sense to me. You can't have one and not the other. So it was a kind of a matching exercise. The money received was taxed as a trading receipt, and we've obviously got those trading deductions are set against it. Well, a little bit on the new residential property developer tax, because our developer clients might mention this to us. So it's probably not going to be relevant to our clients, but they may well ask us, are we caught? So it's useful to have an idea of what's going on with this new residential property developer tax. Now, currently it's consultation. Consultation closes 22nd of July, and it's going to be a new tax. A new tax will apply on profits that are recognised in accounting periods ending on or after the 1st of April 22, so not too far away. And it's going to be on the profits of residential property development companies where they exceed 25 million. So it is very large property developers thereafter. Now, the rate of tax has yet to be decided. It's obviously in addition to the taxes they already pay. Now, the tax would apply to a house or flat that is considered as a single residence, generally together with the grounds and garden of any land intended for the benefit of that dwelling. So very much targeted at residential property developers. Now, as for SDLT, the tax will include buildings suitable for use as a dwelling, where it's not actually used at the relevant time, so suitability for use. Any existing building that's being adapted, restored or marketed for domestic use, and any undeveloped land where we've got residential building permission. So it's going to be quite wide in implication. If we do act for developers having profits of more than 25 million, then they will obviously be interested in this. It is only consultation at the moment. I wouldn't have thought the 25 million allowance would go down. It may well go up, but I doubt it will come down. So what's going to be included? Well, undeveloped land or land undergoing a change in use where residential planning permission has been obtained. They are looking at excluding development of certain purpose-built student accommodation, a lot of that going up at the moment. And specialist communal dwellings should also be excluded. I looked down that list and it's almost been taken from the definition of relevant residential from a VAT perspective. Hotels are not on that relevant residential, but I looked down the rest of it and it's very similar to the relevant residential list for VAT purposes. I would say this is probably going to be an indirect tax. So it's a bit like that, bit like stamp duty, land tax. That's the idea behind it. There are two models being considered. Model 1 is a company-based approach where tax will be applied to all of the company profits, where activities included a not insignificant amount of residential property development. That seems a little bit harsh, Model 1. Model 2, an activity-based approach. So it only applies to the residential property bit. And the tax applies to the profits of that residential property element. So it looks as though we might have to highlight exactly what our clients are doing, which properties are caught by the tax, and look at the profits on that area. So that would be quite complex. Now, the consultation seeks views on how the relevant profits are going to be calculated. Well, method 2, we do need to know that. If and how old and new losses will be relievable by the company. How interest and other funding costs should be treated, registration reporting through the existing corporation tax system. So it does appear to be like a separate tax, which is reported separately, like SDLT, like VAT. The payment of 2, tax due through quarterly instalments system for large companies. So I think it's fair to say this is highly likely to come in. At the moment, it's just consultation. Thankfully, it is just for very, very large clients. But some of them may have clients in that bracket, and they will be playing a very close eye on these proceedings. Other developers might have heard of it, and they might be chatting to you about it, and then we can put their mind at rest. 25 million at the moment seems to be where they're starting at in terms of profit levels. Right, a little bit of that to look at this month. So we've got one, RK Fuels Limited. Now, RK Fuels Limited rented out the car park at its premise to a tenant who ran a car wash business. And you see this a lot round, where you have a garage and they've got a car wash, hand car wash facility there. And this is looking at the garage owner who rented out the car park at its premise for this car wash business. And they treated the income as an exempt supply of land. I'm presuming the car wash business wasn't VAT registered. Now, they treat it as exempt as licensed to occupy land and not as a parking facility, which would have been standard rated. Car parking is mandatory standard. Now, HMRC argued that it was a car park as allowing alternative use to run a car wash. They did not cause the area to cease to be a car park. It was a car park, nor did it mean that it could not be used as a car park. Indeed, cars parked, waiting to be washed. So in many respects, it was still a car park. So HMRC felt they were on firm footing. Now, RK Fuels relied on the following extract from the lease that stated that the car park were used only for the following permitted use as a car wash business. Neither the car park nor any part of the premise will be used at any time during the terms of the lease by the tenant for any purpose other than permitted use. So they were relying on the fact that the contract says we're not letting it to you as a car park. Essentially they were saying this car park, we're not letting it to you as a car park. Now the first tier tribunal decision said, well actually we think it's standard rated, because the words car park are all over the lease. So therefore you can't really get away from the fact that you are letting a car park. And the area being leased was a car park, and cars parked, waited, were washed, etc. So a site for parking is any place where a car may be parked. And the fees for that are mandatory standard rated. Car park is mandatory standard rated. We've got Revenue Customs Brief 5 2021. Now, the construction of dwelling and building materials provided by the person supplying the construction services are zero rated. So if we're helping to construct a new dwelling and we're providing services and materials, they go in zero rated. Now, building materials covers materials ordinarily incorporated by builders in a building. It includes bricks, timber, kitchen units, sinks, toilets, etc. It wouldn't include things like electrical goods or gas appliances or carpets, for example. They're not ordinarily incorporated. Now, prior to the Wickford Development Company case, roller blinds were not deemed to be zero rated. So that was up to the Wickford Developments case. HMRC lost that one. Now, Revenue Customs Brief 521 confirms HMRC's amended policy. The installation of manual blinds and shutters are zero-rated building materials. If you think about it, they are attached to the wall, to the window frame. So they form part of the structure and they are ordinarily incorporated. Therefore, they can be zero-rated going into the property. Now, DIY house builders could use their refund scheme to claim a VAT charge, or the VAT charge, on those manual blinds. So it's not only for developers, house builders, it also has relevance for DIY house builders. And if they're fitting blinds in quite a few rooms, then it might add up to a bit, it might not. It's just a change of policy. They now accept that roller blinds are now part of materials ordinarily incorporated. Now, this new treatment does not extend to blinds that are motorised, presumably because they're electrical. So therefore, they're prohibited. A bit like a gate. Gates are okay when you're building a house and you get the gate. That's all right. But if it's an electric gate, then it's not. And I'm thinking, well, because it's an electrical item, which is specifically precluded. Well, that concludes the business tax roundup for this month. My name's Dean Wootton. Thank you for listening.